What does it look like when two leaders, each defined by experience, innovation, and performance, unite to elevate Canadian real estate lending? With nearly a decade of serving the needs of investors, borrowers, and mortgage brokers in the alternative market, Neighbourhood Holdings has now taken a major step forward by acquiring Fiscal Asset Management, forming one of the largest alternative mortgage lenders in Canada. Together, they manage nearly $800 million in mortgages across more than 2,000 borrowers and over 3,000 investors nationwide. Through the Neighbourhood banner, the team works directly with mortgage brokers across Canada, providing short-term mortgages for quality borrowers who may not fit traditional bank criteria. Every loan is backed by real assets, ensuring a measured, conservative approach, seeking to provide investors with stable income while preserving invested capital. Whether you're a mortgage broker seeking flexible financing options or an advisor looking for regular income solutions, Neighbourhood's expanded reach brings track record, transparency, and opportunity, now even stronger with Fiscar's 30-year legacy. To learn more about the Neighbourhood, visit neighborhood.com to view the offering memorandum or speak to your financial advisor today. This is not advice, and consult a professional advisor before investing a loonie in any of these investments. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 218. As always, joined by the three amigos, Keith Dicker over in Halifax, Rich Diaz in Montreal. Art wall's looking good.
The art wall is complete, I would say. It is a fair representation of what's going on in my brain at any given moment.
Looks like a mess.
It is. Yeah, it is a mess. I would say that's a good description. And it's snowing. Keith, I may take the day off tomorrow to go skiing. Please tell HR. And but no, all is good, man. It's Christmas time, and because it's Christmas time, I wanted to plug my friend's charity. That's right. Steve's grumpy. He doesn't want me to do this, but too bad. You know, at this time of the year, we should all take a minute to think about people who are a little bit less fortunate than ourselves. And my friend is raising money for Courir pour Nourrir, which is a mission, courir pour nourrir, which is French for, running for food.
Say that again.
In French, it sounds a lot better than in English. But anyway, it's for a food bank. You know, there's all this talk about basically food. You know why, but anyways, my friend's raising money for the Moisson Laurentide, which is a food bank out here in Quebec. So there will be a link in the show notes. So if you can, please do give what you can to support this wonderful charity.
Yeah, link in the show notes with 3 E's and accent aigus.
Hey, how dare you, sir? I'm a proud Quebecer. But anyway, that's it. Thank you, gentlemen, for letting me twist your arm into doing that.
That's really nice, Rich. That's really, thank you for doing that. So everyone, check out the show notes for it. So I had a fun week. I was a guest of the Canadian Navy this week.
Cool.
I got that right. Yeah, I was a guest speaker for the Fleet Diving Unit over here in Halifax, and presented. It was about 100 people there.
I was going to say, how many fleet divers in Halifax? Like 2 or 3?
The whole Navy, Keith, all 100.
Actually, these guys have amazing stories. You know, one of them, a good friend of the show, Mike St. Pierre. Boy, these guys can, you're literally just, wow, I can't believe that. It sounds like a book you're reading. But yeah, I had a great time. It was in their hangar. So it was on the hangar, which is literally on the edge of the water. The winds were howling that day. It was snowing. The white caps are out there. It was a lot of fun. Of course, you know, Boomer being Boomer, I start off with looking out and say, hey, I see all you guys dressed alike today. Yeah,
it was such a stupid joke.
I looked at Mike and he went like, no.
Did you guys get?
We had a real good conversation. These guys understand risk and everything like that. And so when I finished, they say, "Oh, we have something for you," and
drum roll.
Ta-da!
What is that?
Drum roll.
What is that?
It's a schooner.
Oh, they give you
Schooner
beer?
Yeah. I got a box of beer, and schooner, the Navy. This is a New Brunswick beer, by the way. Yeah,
Cool.
Did you get to shoot some guns?
they don't shoot guns, Steve.
No, they're Navy divers. They blow
What?
stuff up. They
You
blow
never know when you
bridges up
might meet
and stuff.
somebody
They're
underwater.
mostly finding like World War II mines and like in the Thames and stuff like that, and
That's scary
It's pretty
stuff,
cool.
Keith.
Yeah, it's really but I got some beer. It's pretty
Okay.
fun.
Do you have to declare that?
Yeah, make sure you file that on your taxes this year.
Yeah, that's right.
Will do. Anyway, we have a lot of Canadian stuff. So Steve is helping out a food bank in Montreal. I'm hanging out with the fleet divers in the Navy. And what is Steve doing in Kitsilano these days?
Grumpy.
Not much. Just watching Royal LePage forecasts that are telling me house prices are going to continue falling. I thought it was interesting. There was an article out this week from Royal LePage, which is actually, I think, to my knowledge, anyways, is Canada's largest real estate brokerage company. So they obviously have franchises across the country. I believe they're owned by Brookfield, but they're notoriously bullish. In fact, I don't think they've ever recorded a down year in terms of their forecasts. They came out with a couple forecasts this week across the country, in which they suggested that home prices in Greater Vancouver will fall next year in 2026. They will fall 3.5%, which is really not insignificant. And in the GTA, they noted GTA home prices are expected to fall 4.5% by the end of 2026. So I thought that was kind of like an interesting signpost, which is like almost like a really good contrarian sentiment indicator when your largest brokerage that, is notorious for going on every media outlet and pumping housing is coming out and suggesting that house prices are probably going to fall in Canada's two largest major metros.
Drill, baby, drill. So why would they? So you must have people in your network with that brokerage firm, I would imagine. Like, what's the response? So if you're an agent in that Royal LePage world, are you thrilled with that coming out?
I don't know. I mean, I've always just kind of spoken my mind on housing, so I've just kind of always ignored those forecasts. But I think it maybe makes it a little bit more challenging for people that cling to the narrative. It's like, well, how do you entice your buyer to sort of get into the housing market when they're reading your own company's forecast that suggests you might be better off waiting?
Well, you just don't distribute those forecasts. That's an easy
On another note, though, Rich, Greater Montreal expected to go up 5%. You better buy now.
Amazing. With all that extra cash you're making, you can donate some of that money to Courir pour nourrir. But I mean, isn't the point really that we're seeing kind of things go back to normality just broadly? I mean, for a couple of years, again, I'm out of my lane here, so forgive me, but a couple of years, like everything was just moving all in tandem, all at the same time, right? And then everything fell at the same time. And now aren't the cities just sort of doing whatever it is that their, domestic supply and demand dynamics suggest that they should, right? I mean, isn't that really what we're seeing?
Yeah, I mean, I think the housing market in the whole is obviously going through like a very much needed rebalancing, right? I mean, if I look at not only our national house prices, I think down from the peak, I think they're down 18%, obviously heavily concentrated in the GTA and Vancouver, but vacancies are rising across the country. I think in Vancouver right now, I was reading a report today that the rental vacancy rate in Vancouver is like 3.7%, which is like the highest in, I don't know, probably several decades. And to be honest, I think it's going higher just given the amount of rental construction that's in the pipeline. So yeah, I think we're going through that rebalancing. Funny enough is the Bank of Canada was actually out this week. We had our Twinkie bet last week. No cut as expected.
I even have a box I was going to eat. Okay.
Well, there's an interesting quote, funny quote from Carolyn Rogers, the Bank of Canada. She says, in general, we don't expect another surge in house prices. We do expect maybe a continued correction in some of the higher priced markets.
Well, yeah, no
So
shit.
she's
that we aren't
reading.
importing
So she's reading
millions
the
of
Royal
people.
LePage.
You read the Royal LePage
right.
forecast.
I mean, yeah, dude,
This
we're
is-
not importing through like millions and millions of people every year. Of course, it's not going to go up to the same degree.
Yeah, none of this is news to any of our Loonie Hour loyal listeners here, but yeah, I don't know. It just that seems to be the general consensus, right? Is consensus is another slow year ahead for housing, but the BOC, Rich, I know you paid closer attention to that.
I did.
No cut. Seemingly, what was your kind of takeaway from the presser?
I thought what was interesting is the amount of time that they spent on revisions. And I know we talked about it a couple of weeks ago, but it was important. He did mention the economy was better than they thought, that demand and supply both increased. They mentioned that productivity did improve. I talked about that on my video this week, that productivity was upgraded. Still shit, but upgraded, which is good. He also talked about inflation. I think that, he said, there was one question which I loved. He was like, people see inflation rates falling or steady anyways. And he said, he's like, prices going to fall? And he's like, no, we are not going to see lower prices overall. And I laughed because it was not very long ago when they were trying to convince everybody that inflation was transitory. And I thought was funny. The other thing that I thought was really, really important was there was a whole section on his commentary about how we need to diversify our exports. And he went on to say exactly what I've been saying about the TMX pipeline expansion, allowing Canada to diversify its most important exports. And what was really important is that he went to lengths to say that it was really helping at the margin, and how not only does it literally allow us to export our oil to a new market, but that it actually increases the value of every barrel of oil we send to the US, because that spread, which is the difference between the WTI and the Western Canadian Select, I always screw that up, is narrowing. And so that was something that he talked about. It's always funny whenever he talks about oil, I feel like he gets like squeaky, he gets like uncomfortable, and you can see him like shifting in his chair because he doesn't want to say like, he doesn't want, the Green Party to come, I don't know, torch his car or whatever, but it's too funny whenever he talks about it. It is true, and it's very, very important, but it is funny that he gets uncomfortable. And then fundamentally, I think he said, Canada's working through structural transition. So I really don't think they're going to cut. The market's already starting to price hikes. Again, we've talked about why you should take that with a grain of salt. And finally, I guess he said that the overnight target rate is at the low end of what they call the neutral rate, which is sort of the band at which monetary policy is not inflationary or disinflationary. So there you go. It was a kind of a big nothing burger as far as a meeting, but there was a couple of nuggets of worth taking away.
Keith, before we get over to you, just effectively, Rich, to summarize, there's no cut priced in for 2026. I think at the end of 26, I think the markets technically are pricing in the possibility of a hike.
Right. But
so, I mean, what I found interesting is just to see the movement in bond yields over the last week or two, that Canada 5-year that everyone's followed, and my mortgage is coming up for renewal in 2026, and I got to wait for lower rates. And yeah, I think what we've seen is I think they're up like 30 or 40 basis points over the last month. So pretty big move with the jobs numbers coming in stronger than expected, GDP being revised higher.
So what has that done to 5-year mortgage rates now then on the fixed side?
You're going to be up. We've seen the lows probably for this month. I mean, your 5-year today is at 2.95. A month ago we were around 2.65. So yeah, 30 basis points. I mean,
it's moved a lot.
Your fixed rates should move. I wouldn't say, 1 for 1, but I'd say, at least 20 basis points. So your 5-year mortgage might have gone from 3.99 to 4.2. If it hasn't yet, it probably will in the next week or so.
Loonie Hour math.
It's up 30 basis points. Yeah. Okay.
Thank you, Keith.
Yeah. Carry the wine.
I was trying to figure out what it was. I mean, one thing I think that they're just being real. Our ICE cap inflation model continues to suggest that inflation is going to shoot higher. Again, you have to be models should not be married; they should be dated, and you got to be careful about what that means going forward. But I think they're being way too sort of relaxed about what might happen on the inflation front, especially if they just conceded that the economy was better, that the labor market, despite the math problems around the labor force, is better, and that they're, I think that, and they're not interested in cutting any further.
Did they spend any time on tariffs?
They did actually.
Tariffs come up.
Yeah.
Or
didn't come up. I wish we should run all the meetings through AI. They didn't. What was funny is that he talked about that actually, he made the point that most of the economy is not affected by tariffs. Now, he obviously singled out steel, aluminum, and autos, but he basically said that most of the economy is not affected by tariffs, and that the average tariff rate is one of the lowest in the world with about 6%. And outside of the tariffs, Canada's economy is basically ticking along. I don't know if I agree with that, but that's what he said.
You got that line.
So that's a big shift because the last meeting, when things weren't going as well, they were, hey, tariffs is causing all of this. They're bad. Now it seems that they're not as bad. It's interesting, just to follow it.
Well, we'll circle back to that conversation. There's more we want to discuss. There's more things to sort of expand on in that. But Keith, you've got a special guest. So we introduced a theme in the Loonie Hour. What, Keith? A couple months ago. We've kind of been slowly introducing it and ramping it up. But one of the key theme really has been like, listen, the Fed is going to cut, but more importantly, is they're going to reintroduce QE, quantitative easing. Call it what you want. Some people say it's money printing. Other people say it isn't. But Keith, you wanted to bring on a guest to sort of elaborate on what's happening in that market. So do you want to expand on who we got coming on the show here in just a sec?
Yeah, absolutely. And I think it was about 2-3 weeks ago, the Loonie Hour said, hey, QE is coming. And the reason for it was because the amount of bank reserves in the U.S. system was getting really low. And it's kind of funny. I had a couple of guys email me and they say, hey, you're full of, shit.
Oh, really? Did you?
Oh, yeah. Oh, yeah.
They're
not doing QE. And, I'm like, yeah, what do you know, pal? So anyway, they did do that, of course. But today we have one of my friends. His name is Jim Yorio. Jim is based out of Chicago, and he's been trading futures, options on futures for a long time. He's a macroeconomic guy. He does technical trading, all kinds of interesting things. He deals with the hedge fund world, as well as trade desk. He's frequently on the big networks like CNBC, Bloomberg, Fox, and stuff like that. And he also runs his own podcast as well with another gentleman. It's called the Futures Edge podcast. So he can share some of that with us. Get it, Rich? Futures?
I get it.
Yeah. Steve, do you get it? No?
Yeah, I'm still here.
Yeah.
Okay. Everyone stay with us. Anyway, Jim has been in high demand this week, to share with everyone what's been happening at the Fed. And he said, yeah, he's more than happy to come on and chat with all of us up here. So let's welcome Jim to the show.
So without further ado, let's jump over to Jim's conversation right now.
Okay, everyone, welcome back. We have Jim Yorio with us today. And we've already introduced you as being this really smart guy, down in the futures exchange. I spent some time on the floor there years ago with one of these CFA mock-ups in the pit. It was a lot of fun.
Which floor, the CME or the Board of Trade?
It would have been the Board of Trade.
Okay, because I was at the CME like the first 20 years. And then when the CME bought the Board of Trade and the products that I was well-versed in moved over there, then I went over to the Board of Trade. So I've been in both exchanges in Chicago.
Yeah, this was actually, obviously after hours and everything. And so we couldn't break anything. But one cool thing about Jim for everyone to know, this is what you shared with me recently, that you got in trouble once on a CNBC interview because you supported a Trump policy. And then you got in trouble on a Fox News interview because you didn't support a Trump policy. So, maybe we can talk about those things as well. But maybe for today, though, it's Central Bank Week. And I think it's good, though, for people to, to hear what you're seeing and feeling, and obviously you have a great network, but just share with our audience. Everyone is Canadian mostly. What's happening in the U.S. and why it's important to us. So why don't we just start with? You want to start with one of those interviews you can where you got in trouble, or you can go into the Fed.
Well, I can't decide because some of these people are litigious. I will just say that the first financial network that you mentioned, we ran into quite a bit of trouble, and it was obvious because they were angling towards someone who was going to be more critical of Donald Trump and his policies. So I don't know if you noticed what happened at, we like to call them the TMZ of financial networks. And I don't like to mention their name because even though I'm 100% right, I don't want to get smacked with any sort of lawsuit, but they seemed to divest themselves of anybody who was an independent and who judged each policy based on the policy itself. Who'd have thought of that? I mean, because what do I give a crap about what politician put forth a certain policy? A policy is either a good policy or a bad policy. This is something that is so foreign to me to have people who support a different candidate saying, you shouldn't talk about politics. I talked about a policy. Anyway, now I'm calm. We're fine now.
We had the same problem in Canada. Don't worry.
Yeah, Rich got in trouble with one of these guys up here as well recently, right, Rich?
Yeah, that's me. That's my role. But Jim, a really important question before we go into the Fed. Have you ever seen the movie Trading Places?
Seen the movie Trading Places. What kind of questions that? I used to, by the way, my interns and my new employees over the last, call it 35, 40 years, I would literally in the first week make them go watch.
Oh, I love to hear that. I love to hear that.
So a little funny background on that is one of the guys who got me into the business was one of the board of directors at the CME by the name of Rich Capsch. And he was on the board when whoever made the movie, I can't remember who the director was, but anyway, they came to the CME to see if they could shoot the scenes there, and the CME said no, so they went to that. Those are Comex scenes where they film them, I think. By the way, and it is so funny when guys like us watch it who've been on the pit, like you remember, like it's like almost seems like a dance in the pit where someone's telling them, "Okay, go crazy now." So, which we did go crazy quite a bit, but it's a funny movie. I love that movie. Yeah.
Jim, why don't you want to recap us, like just your overview, your takeaway from the Fed meeting? Obviously,
sure.
We know they cut rates by 25 basis points. Was the third consecutive 25 basis points cut? What was kind of your overall summary from that meeting? What maybe caught you by surprise?
Sure. So it wasn't, this was actually kind of my base case, but I'll say what seemed to catch the market by surprise. And for that answer, I'm going to go back to October 29th Fed meeting when they eased like the market said they would. And then he kind of tried to throw a wet blanket on expectations for future easing back on October 29th. And that kind of caused, maybe not caused is the wrong word, but it helped along a 6% decline in the stock market, which even at the time, I thought it was kind of weird. He always says the same stuff, which is data dependent, nothing set in stone. And I don't know why we interpreted that as him saying there's no more eases coming, because obviously there was and is. So going into this meeting, I'm of the belief, and I'm curious to get what you guys think of it too, because sometimes I think I'm alone on this. I think if we're a week before the meeting and the futures markets price in greater than 80% chance of an ease or a tightening, if we were in that kind of cycle, I think the Fed has zero choice but to go along with what the market says or risk disrupting financial markets. And they don't want that. So I think that even if the week before the meeting, they're like, oh, crap, we really don't want to ease, but futures market says we have to, I think they ease anyway and then try to message better going forward. Anyway, so going into yesterday's meeting, odds were about 90% for ease according to the futures markets. And I believed they were going to do it, and so did everyone else. I wasn't any kind of rebel there. But what was interesting to me is when they announced QE. Now, the funny part is it only became aware today that they're trying to package it and calling something not QE. Someone said to me, well, they're not calling it QE. And I don't give much of a crap what they call it. QE is QE. So the Fed is going to be buying and expanding their balance sheet. And for those who are watching, you guys, it's a pretty simple concept. The Fed creates money, buys bonds from the treasuries. That increases the net amount of money and liquidity in the system. Now, a couple of reasons that I think they're doing it is that if you look at the chart of reverse repo, and everybody, like reverse repo for years to me was this complicated thing until it kind of dawned on me. It's just the money that's in the reverse repo facility is money that's looking for treasuries to swap out, swap into. So if it's high, there's high demand for treasuries. Well, the reverse repo facility has gone straight down and has been hovering at very, very low levels basically for the last third of 2025. So I think the Fed's extra dovishness was threefold. I think one, he sees the reverse repo and there's not quite demand for the short-term treasuries that they want. Remember, he criticized Janet Yellen for not selling on the long end and always concentrating selling on the short end. And then he's doing the same exact thing. So he's worried about demand. So he's going to step in and be demand. I think he's worried about the labor market, rightly so. Like, I think that AI is disrupting the labor market. I think he knows the labor market's being hampered, but he doesn't, not sure by which reason. But I think it's because of AI, and I don't even necessarily think that AI is going to be the answer to these companies. I think they think it's going to be the answer right now. So they are reducing, not necessarily reducing headcount, but reducing new hires. And I think that stagnated the labor market. And three, I think he knows that the US government continues to spend like drunken sailors, which, by the way, you guys in Canada, do they say something else besides spending like drunken sailors? Because I think I've said it about 5,000 times on camera, and I want a new thing to say. Do you guys got anything?
We call it austerity. We call it austerity.
That's our definition of austerity. Yeah. So you guys, I know you watched not only the Fed balance sheet, but M2 money supply, our national debt, it is absolutely exploding. Our debt to GDP sitting at 118, still ridiculously high. I think that we all hoped, and by the way, I still have this much hope. We all hoped that a Trump presidency would bring about some level of sanity regarding the spending equation, or maybe a boost in GDP. So far, none of those things have happened. But I did think that 2025 was going to be a relatively rocky year before some of the good parts of Trump policy start to affect us in 2026. I have much less hope of that now. Like, I thought this, and I want you guys to tell me if you think this is crazy. When the election happened, I guess that was a year ago. My thesis was this, is that one party seems to be 90% assure us some sort of bond or currency. To call it a crisis might be a little hyperbolic, so let's call it a kerfuffle. But the other party, the Trump party, was 60 to 70% likely too. Like, I didn't think he was the panacea and was going to implement austerity, and he doesn't. Every week goes by, he talks about, I'll give you $2,000. I'll give the farmers $12 billion because my tariffs hurt them. I'm not going to sell my gold position when he's giving away money like it's nothing. Where can you poke holes in that, Keith or Steve or Richard?
It kind of ties in with, our overall theme is that, really over the last, you go back to the solution or the response to the housing crisis that happened back in 08, 09, that the whole world has literally been in a constant need of stimulus all the time. So whether it's monetary stimulus or fiscal stimulus is coming through, and the moment that the taps slow a little bit, some folks get hurt. They say it's kind of because right now we're in December of 25 and December of 18, because we had the repo crisis back then. Mm-hmm. So it's just where we are. So I'm really one thing is interesting because you started off your Fed observation. They cut, but everyone knew they were going to cut. And yeah, I do agree as well. If financial markets are pricing something, if they have enough time, they'll try to talk that view out if they can. They're going to call JP Morgan and say, hey, you guys are off sides here. You need to get back on side. But they spent a lot of time yesterday on QE and repo. And he wasn't calling it that, but because one of the questions was focused on it. And he devoted a lot more time to that question than all of the other ones combined. So we'll come back to that. But the other interesting question, it was funny, someone said, hey, you had 3 cuts so far. Inflation is still at 3%. Stock market is at all-time highs. And yet you're still cutting rates, And again, I think it goes back to the responsibility of central banks today is controlling, the plumbing in the system. I like to say, professionals are looking underneath the rate story to see what's happening. But that's what was standing out for me yesterday. What were you thinking, Steve?
Oh, I was just going to chime in there that they're not calling it QE, Keith. They're calling it Technical Reserve Management Operation.
Oh, nice.
So
you said that with a straight face, Steve. I like that. You're very well composed, because that is the more complicated the moniker they give it is, the more they want the average Joe to not understand it. Right. That's why I didn't even listen to what they were calling it, because I don't give a crap what they call it. QE is QE, right?
So Jim, what's been happening then, if we can kind of like circle back to the earlier conversation, which is in the reverse repo market? Like, I guess in more layman's terms, like, the Fed is clearly worried about it, but I guess sort of what's been happening in that market for our audience to really understand how we got here, how we're getting back into QE to begin with.
See, okay, so that I'm not going to have that great an answer for that, because all I really care about is the net level of what I view as demand from the repos for treasuries. So that's all I care about. And the fact that it's down from what was that, 2.5 trillion just back in the beginning of 2023 to 2.5 trillion to 200 to 28 billion or something right now. The collapse has been amazing. So to me, okay, so to put it simply, is that liquidity jumps into the system. You guys understand this. And then the reverse repo, some places have need for cash, some places have need for treasury overnight. So they swap it back and forth. And the liquidity, the more liquidity that's in the system and the more demand there is, the more money is in the reverse repo system. The fact that it's dwindled to this, the bottom line, all I care about and all I tend to go into is the fact that the policies of the last 5 years of terming everything short term when the Treasury sells bonds, those days might be numbered. And that's why the Fed feels that they have to come in and support that. I'm sorry, I don't usually have a very good, more complicated answer to that. Is that okay, Steve?
Well, let me just quickly jump in there. So when you say term, just to slow it down for some of us who may not understand. So what that means is like the Treasury has 30% of all the Treasury securities are basically due to be rolled over the next 18, 24 months. Yep. By the way, it's a similar situation in Canada, just for people paying attention at home. Yeah. Europe, it's much more uniform. But why is that a problem?
Okay, because do you remember before we started, Janet Yellen changed her focus to the short end? There was about 3 out of 6 longer term auctions that went very, very poorly. The demand was not there. Trying to think of when that was. I want to say like between the middle of 2023 and the middle of 2024, there was 3, and anything longer than 7 years was not met with good demand. Now think of this: the people who are listening, is that prior to that, the Fed was the buyer of last resort. The Fed was there to buy long-term debt with their quantitative easing program before it was relaunched yesterday. China was a big buyer of our bonds. China stopped buying our bonds, well, at least slowed down. So did many other countries who we've kind of put on the naughty list. So all of a sudden, the Fed backs out. So the demand there for longer term paper, longer term duration wasn't there. So Janet Yellen went to the short end and started selling there. And this is an oversimplistic view, which, by the way, as a trader, I like an oversimplistic view. I don't like to dive too much into it, because if I can get 80% of what the actual story is and then trade off that, and we'll talk about the trades, because I think it was a rich trading environment, investing environment over the last few years. So now we're in a situation where we're worried about demand, even in short term, even 2 month, 3 month. Now, a lot of people are going to say, why the hell didn't Janet Yellen, or who was right before Janet Yellen? Who was the Treasury Secretary? It escapes my mind in a second. But when short term, when 10-year yields were near zero and 30-year yields were near zero, why the hell didn't you sell all your debt at 30 years and not have to worry about it for such a long time? Well, they didn't. And I think their average duration was in, 5 or 6 year area. So they have to now, like you said, they have to roll that over as it comes due. And they were looking at doing that without the support of the Federal Reserve. But now, fortunately, the Federal Reserve is back. And guess what? Here's the Fed is going to buy short term. Now that they're buying again, it's a shorter jump to buy 7-year and buy 10-year and support those auctions as well than it is to start it up again. So I think that the door has been open, the camel has its nose under the tent, and it's very difficult to get out of that. So I think, again, that has been my base case for very long. And there's something that I want to put to that, is that just 2 months ago, I talked about it in a speech in New Orleans, and the speech was called, the debasement trade, or the case for how to play the Fed or whatever. So my debasement portfolio is gold, silver, platinum, Bitcoin, real estate, and stocks. And stocks are part of the debasement trade as well, too. And my thesis was that, and I've been saying this in stump speeches for years, is that eventually, because of the spending, the Fed will have to reopen quantitative easing to support the bond market. Now, the issue is, can they support the bond market? The answer to that is absolutely yes. They can support the bond market, but at what cost? The cost will be to the currency. And that's what flashed us yesterday. And that's what the silver has been sniffing out for some time. Well, gold's been sniffing it out for years. And it's like Thomas Sowell says, there are no solutions. There are only trade-off. Stabilize the bond market all you want. You could crush your currency. It goes back somewhat to what James Carville said about when he died, when he's reincarnated, he wants to come back at the bond market because everyone's scared of the bond market. Well, everyone's scared of the currency market too. So to me, it's just like borrowing from Peter to pay Paul. Does any or all of that make sense?
I mean, yeah, it does to me. My question is just about interest payments going forward. I mean, we're seeing
1.4 trillion this year, right?
And it's growing. I mean, Canada has a similar situation. It's not as bad as the US. I mean, how is that? What's the next stage in this? Because the US is obviously the most important currency in the world. The US dollar is the most important currency in the world. It's a Federal Reserve currency. I mean, they must be aware that this is going to cause foreign investors some consternation or not, or do they not care?
No, I think, well, okay. So my base case for politicians is that they're probably too stupid to care, but not for guys like Scott Bessent, because I think he's
switched on. He's no fool.
No, he's no fool at all. So I really genuinely like him, and I think he knows what the situation is. But I think there's not real solutions. They have the one opportunity is that if they can really follow through on massive deregulatory measures coming up, if they can really follow through on all this foreign investment that's been promised to come to the U.S., and all those things can boost GDP significantly, then the drunken sailor spending won't look quite as bad. Now, to me, that's a hell of a risk to take. We started the whole Doge thing with Elon Musk. And again, it was started with great fanfare. I never really believed that they were going to do much. And again, it was like throwing a deck chair off the Titanic when you looked at the measures they were going to cut. And again, I don't think we should be funding gender studies of squirrels in Zimbabwe. I think all that stuff was stupid and should be cut immediately. But it's not what we have to do is boost the heck out of GDP, because they're not going to cut Social Security. They're not going to cut defense spending. Those things like Social Security would be a relatively low-hanging fruit. All you'd have to say is that, when we started this off, the average life expectancy in this country was 62. Now the average life expectancy in 78. We can't, you have to bump that out to 70 before people can take full advantage of it. They won't do that because guess what? Old people vote. So the only window that's open to save us from a bond problem and a currency or a currency problem is if deregulation and foreign investment can boost the crap out of GDP starting in about mid 2026, because I think the fuse has been lit. And again, I have not just gold in paper gold. I've been advocating, I work with the American Gold Exchange as well about getting people physical gold. Again, I sometimes love when my dogs start barking at the mailman going by, because I want people to know that, yes, I have a lot of physical gold and I have lots of dogs and guns too. So come and get it if you want.
It's kind of funny you say old people vote. I think some of the old dead people vote as well.
I'm from Chicago, Keith. All the old dead people vote. Yes. And my dad, who has been voting Democrat for almost 9 years, and I know that would just irritate the crap out of him if he was alive. You got it. It took a second, but then you got it.
I got there.
It took Rich a while to get there.
I got there.
It's just, I have two questions. I hope maybe, it doesn't matter which order you want to address it. What do you think the reaction is by other central banks to the whole restart of QE? So the Bank of Canada or the ECB, BOE, anyone like that? And as well, I don't know if you're in the corporate credit world as much, but credit spreads remain tight, and they're sort of suggesting a different story than what we might be seeing elsewhere. So maybe you can go on those two subjects for a little bit.
So I'll start with the second one too, because I think I look at the corporate credit thing all the time, because I think when credit spreads bump out, that's one of the early canaries in a coal mine for when things could start to head south. But I also view it as a massive indicator of liquidity in the system, because I think money will get, very quickly get sick of a low rate or low return somewhere, and will walk out the risk curve to something more risky for less reward than people like you and I think it should. So when I see credit spreads as tight as they are in an economy that's kind of wonky and weird, but again, I will say that wonky and weird economy is mostly about the labor market to me. And I'm sorry if you people are tired of hearing K-shaped recovery, but it is in fact a K-shaped recovery. I mean, the 10% of the consumers in the United States have 80%, 50% of the consumption. 10% own 30% own 90% of the equities, and we're making money our assets, where all anyone else is getting is higher beef prices. So I think the chairman is adding liquidity into a overall good economy, but he realizes how bifurcated it is. And that will the credit spread part of that is important. They're very, very tight because we know we have an okay economy that's being treated like a bad economy because it's not working for everybody. And the liquidity is being injected in the system, and those credit spreads get tighter and tighter. Now, as far as us embarking on quantitative easing when the rest of the world was not, and you saw the move in the dollar yesterday and all the corresponding currencies, the Loonie's up quite a bit over the last month or so too. Now, there is a chance that these other countries will be irritated if we're devaluing our currency and they're not. And then the currency trade is such a weird thing because you want it to be strong because you don't want inflation. You want it to be weak because your exporters you want them to be able to make money globally. So it all that matters is if it gets to extended levels. And I don't think it is right now, but there is a chance that the rest of the world might become irritated if we start diluting the value of our currency as well. By the way, just about global trade, the story with NVIDIA and the chips the other day, I thought it was a bigger story than the market's actually giving it credit for, because Donald Trump with his going at this trade war with a hammer. I think that was like a bridge built between China and the U.S. As Frederick Bastiat always says, either goods cross borders or soldiers do. And I think that was an interesting headline that we're going to sell chips to China, and a good one, unambiguously good. Maybe not good for the AI trade, because that had stretched a lot. And then the Oracle debacle came yesterday. But I think that those are very interesting facets to the conversation. I know.
Sorry, Jim, just to be clear, sorry to interrupt you, but just so people understand, so you mean good in the sense it takes a little bit of the heat out of that kind of the trade tensions. That's what you mean?
That's exactly what I mean.
Lowering the temperature.
Lowering the temperature a little bit, which is a good thing. And we've all seen Donald Trump. He's been in the public eye for 50 years, and he likes to start off with a hammer and then back down and make a deal. One of my good friends, again, I'm not above name dropping. I hope that's okay with you guys. But one of my good friends is Larry Kudlow, and I speak to him, on a weekly basis. And he always says, and he's real tight with Trump, is that Trump has a very specific way. This comes as no surprise to us, of negotiating, and he feels that he's best at it, and he won't back off at all. So when he says these things like I love tariffs, guys like us don't believe that he necessarily loves tariffs. He might love tariffs, but that's part of the whole negotiating strategy. No, and you guys up there probably even most of the rank and file unimportant people like us in this country were like, well, why the hell are we going after Canada again? I thought we liked Canada. They seem nice to me, and all of a sudden we're going after them in a trade war. I never understood that at all. There is a small argument to be made that the government of Canada had some protectionist measures that were onerous on other things. Us in financials, I tried to trade Canadian BAs many different times in my career, but sometimes the settlement procedures and the cross-border trading of it made it somewhat difficult to do. So I don't know if that goes on in milk and things like that, but it's interesting. It's very interesting.
Keith?
Wow. So, yeah, so all this is tied together. I love the NVIDIA comment, of course. We're always looking at what's happening around the world, how it's coming back to Canada. And I keep going back, of course.
Oh, by the way, Keith, can I interrupt you for 1 second? Because I, in my mind, if the United States and China come to terms on trade, that's definitely good for Canada as well, because it's good for, you guys export a lot of stuff to us. And if it's good for our economy, it's good for Canada as well, right?
I think it's good for the world. So I think it's very clear that the Americans are trying to disassociate themselves with the whole Ukraine, NATO, Russia war. They want to move away from Europe and really focus more on China. They're making big announcements to do that, big policy decisions as well. In this NVIDIA, I guess policy change or blessing, whatever you want to call it, that is a step. I think it shows everyone that the focus is shifting even more from the Americans and China. And of course, the Europeans don't like that at all. Right. Oh, yeah. They're being left alone. I think that announcement just says so many more things that the world needs to listen and hear. And it could be as something as micro as, hey, maybe trade gets better. But I think it really, though, more importantly, from the bigger picture, is telling everyone, wow, the Americans are definitely shifting their attention away from the old world, and over to China.
So what's interesting is that in some ways, I think that the tariffs on Canada and the initial problems with Canada and even Europe, I actually think that Trump was just it's always just been about the United States and China, in my view. And I think that was like ground cover. Like, you know what I mean? Like, oh, no, it's not just about you, China. I'm doing this with everybody to see if you can come to the bargaining table. And I think he thought that'd be an effective negotiating strategy. And I hope he's right. And I hope he drops a lot of the tensions with Canada. I like our neighbors to the north.
Jim, just to give you some context, I mean, the politicians in Canada were, I'm trying to not get myself in trouble, so let's just focus on
get yourself in trouble again. You mean.
What the rhetoric has been that Canada's relationship with the United States is quote over, and that there's been a major pivot to Europe. As recently as a couple of days ago, with respect to the internet, digital IDs, certainly central bank digital currencies. Obviously, the military, some rare earth stuff, oil, et cetera, et cetera. I mean, I'm of the view that that's never going to happen, but it's unequivocal. There has been a political shift in their sort of gaze at what they think is important. I mean, from American standpoint, I mean, do you guys even notice that on the newswire? I mean, is there any kind of, you know what I mean? Do you care? Do you know? I mean, maybe you care.
Of course we care. But to your point, is it, how do I say it? I love Canada, but the size of the economies is so much different. And do I think that we're going to move away from who we share our 3,000-mile border with? Of course not. I mean, there's the economics of convenience that are so much more important than any today politician. So I think that whole thing is nonsense. I don't think we're moving away from each other. So I think that we're fine. And I think, again, Trump won't be here forever, and Canada and the United States will.
Yeah, I share that same view, but I mean, how do I say? There's some news outlets that are desperate to restore that schism. But anyway, Keith.
Yeah, it's all interesting, but Jim, I think it was a great conversation we had today. I have another sort of non-financial question for you. You and I will make a bet on the big football game coming up between the Bears and the 49ers coming up in a few weeks. Mm-hmm. So make this up. Okay. Maybe you're a Bears fan, I assume, where you are?
Maybe I'm a Bears fan. Yes, no, I'm a huge Bears fan. My dog is named Peyton Butkus Yorio.
My dog is named after Patrick Willis, so we got a lot going on here.
Fantastic. Just yesterday was Dick Butkus's birthday. May he rest in peace. So I'm a huge Bears fan. San Francisco's a nice team, though. I think they're very, very good. And the Bears aren't all that great. When they were 9-1, all those games, like, they were doing their best to lose it, and just Caleb Williams is too good at the end of games. That's one thing I will give the Bears, is that if I have one drive to go in a game, I'll take Mahomes. I'll take, what's the guy from Buffalo's name? Josh Allen. I'll take Josh Allen. Then I take Caleb Williams right after that. I think he's really good at the end of games. He can run and he uses legs. Thoughts?
Steve went to his first NFL game ever 3 weeks ago. So Steve will now tell you he's been a lifelong Buffalo Bills fan for 3 weeks.
Love the city of Buffalo.
He did have a lot of fun with it, but we'll do some more banter when that game is coming up. It's
yes,
Jim. Before we
second last one,
before we let you go, I kind of want to just get your closing thoughts on sort of future direction. So again, we've just restarted QE. What's kind of your outlook for the year ahead? Just like, I know markets are so hard to predict, and so we're not going to hold you to account here.
No.
But like,
by the way, I predict markets all the time because I don't care about being wrong that much. I'm hedged. I don't, like, so many people don't want to say exactly what they think. I don't care about being wrong. I don't, whatever. I manage my money how I manage my money and my clients' money. I think what happened yesterday was very, very good for risk assets and for the debasement trade. Now, the debasement trade, including things like silver, copper, platinum, palladium, is also the next level AI trade, which is about energy, which is about data centers. And that's one of the reasons I've been long up to my eyeballs, those things, for quite some time. So I think stock markets will like what they see. The stock markets, they tend to like easy money. So I think the stock markets will do quite well. I would like to see, the NASDAQ is definitely, in my opinion, in a rotation period. The AI trade became stretched. everyone was talking about a bubble, including myself. Then a couple things happened. One, the torch was passed to Google on the TPU chips. So instead of focusing on how stretched valuations were, we stretched on, oh, this is an interesting story. Now Google is going to be part of this as well. And by the way, I own a lot, and this is, I talk about on my show, The Future's Edge, all the time. I've owned a lot of Google for a lot of years because my full belief is that a Google is an arm of the US government and specifically the CIA. You guys can tell me I'm crazy all you want, but I will say this. If we ran the intelligence operation in the United States, would we let some other company gather intel better than we did? Anyway, I'm on a rant, but I think that stocks are going to do well. I prefer the S&P to the NASDAQ because I think it's stretched, but I think it's going to be fine end of year into the end of Q1 of 2026.
Jim, what are your thoughts on like the crypto markets? Obviously, they've been lagging recently, but I mean, they're typically a good proxy for liquidity. If you've got the Fed sort of stepping back to the liquidity spigots, do you have an outlook on that?
I do.
Forward?
Well, here's what I'm thinking is that I never can decide if Bitcoin is supposed to trade along with the NASDAQ, which it often does, or trade along with gold and silver, which it often does, but sometimes does not. Yesterday seemed like the best day ever for Bitcoin because it should have been, because it didn't have to decide. The news that came out of the Fed was unambiguously good for the NASDAQ and unambiguously good for the debasement trade, silver, gold, the store of value trade. So Bitcoin started to rally with them. I was like, okay, this makes sense. Then Bitcoin turned tail and closed very poorly. I think any subsequent weakness in Bitcoin over the next couple days is bad, and I think it'll head back down to the 80,000 level. Why? I can't. I don't know why. I don't even know what I have a lot of Bitcoin, but I mostly got into the trade because of broad institutional adoption. I.e., when BlackRock said they were getting into Bitcoin, I tripled up my Bitcoin position because I like to be behind BlackRock on a trade. So I don't know why everybody seems to be selling it right now in a time that it seems like the backdrop is very strong for cryptocurrencies, but I'm going to back off and wait till it can find a real tradable bottom.
Can I ask one last question? And just if you don't mind, sorry, but just because I'm really curious now. I mean, you've painted a really interesting and positive outlook for real assets, which I share. You've paid a relatively negative outlook for Main Street. Donald Trump he came on a ticket that he would reverse that. He's accentuated that, just like many other Democratic presidents have before, and many will again. But ultimately, they cannot in perpetuity remain going in different directions. Or can they?
So you've seen the first time really in history is that sentiment numbers in the United States are going lower quickly while stock prices are going higher. Now, some will say, like, look at sentiment's going lower despite asset prices going higher. I think it's because asset prices are going higher and people are so irritated. The 60% who don't own assets are so irritated and feel that they're left out and that's why we're seeing people like Mamdani win in New York, a socialist who says he's going to basically destroy everything in California, in Miami. We're seeing a really interesting ripple of people that feel that they are left out of the economy. So how do you get those people back? I think the answer to that is we got to really reduce regulation on home building, because I think home building, healthcare are the two primary things that people are really ticked about how much it costs, including myself, despite the fact that, whatever. So I think that if you can deregulate, but again, that's more on the local level.
That's what I was going to say, state and local.
Right. And we're electing politicians who realistically will probably increase regulation. So again, I don't want to dig a bunker or anything, but I have some very serious worries about where the direction we're going.
I mean, Canada shares a lot of this in different ways, but we share a lot of the similar issues that we have. Yeah. We are very much a bifurcated society on who owns assets, who doesn't, old versus young. Right. I think East Coast versus West Coast, and a government, frankly, that's unwilling to really properly address those issues because of. But
even more so, Richard, is that they oftentimes will launch a policy that sounds like it's going to address those issues and exacerbates the problem. We've seen that forever. Like, I hate to bring up Thomas Sowell all the time, but he says the last 50 years can be characterized by policies that worked being replaced with policies that sound good. And I think that's what we see all over the place.
I mean, that's Canada in the nutshell. And I love Thomas Sowell, by the way. He's one of my personal heroes.
Yeah. Anyway, but it's the same though. But this is happening in Australia as well. Across Europe and
in the UK. My goodness.
Yeah, so this the whole K-shaped economy. It is real.
Right. And I don't think we're at the French Revolution period. I think we're miles and miles away for anything like that. But I do worry when such a large part of the population feels that they're being left out of prosperity.
I think as long as employment remains stable for the bottom part of the K, that makes sense.
Yeah,
then we're okay. But as soon as job losses occur down there, as soon as, if you're working all day, the last thing you want to do when you get home from work is, to go down to the town square with a pitchfork. You don't want to do it.
I agree. Yeah.
Yeah. So it's real interesting that, obviously you're seeing, they have the same observations that we see up here. So Jim, why don't you share with everyone how people, if they want to, connect with you a little bit better,
please,
or hear more reviews, what's the best way for everyone to do that?
Easiest way is on Twitter at Jim Yorio, and I post just madman rants, anything that pops into my head, and I will irritate you if you follow me at least once, but some you might agree with. Unfilteredinvestor.com is our newsletter. Myself, Mike Arnold, and Bobby Acino. Mike Arnold has what I consider one of the most amazing technical strategies, and mine and Bobby's job is to kind of blend the fundamentals in with that. And the Futures Edge podcast, it's about 80,000 views across platforms. It's getting some really good traction. That's Futures Edge on any platform you want to. But listen to the Loonie Hour first, of course. But if you have any extra time, the Futures Edge podcast. Yes.
Jim, we'll make sure to plug that in the show notes for your podcast and your site there. So want to thank you again so much for coming on the Loonie Hour. First time we'll have to have you back on as we watch how this all plays out in the year ahead. But again, thank you so much for taking the time.
Thank you so much for having me. I love trading. I love talking about it.
It's a good interview there with Jim. I think gave a little bit of variety or different context, Keith. I think he seems pretty bullish risk assets. I think, sometimes we can be on the more pessimistic side at times. But, again, Fed cutting, QE started. Rich, I don't even know what markets are pricing in for additional cuts next year from the Fed. We know it's 0 for the BOC.
I will keep tap dancing and I'll check for you.
It's like one to 2 next year, I think, isn't it?
Keep tap dancing. I'm almost there.
But the great thing with someone like Jim, again, it's one thing to be a trader, in the equity world. When you're trading on the futures market and options on futures, and that's where he is. By the way, he mentioned a whole bunch of different trading floors, but the CME, that's basically where currency futures are traded and bond futures are traded. Whereas the CBOT, that's where gold is going to be kind of like agricultural commodities and stuff like that. But there's a big regulatory battle in the U.S. between the futures market and then the SEC, which is controlled the stock market. So when Bitcoin came out, it's going to be traded, they're both fighting over this. So if you're a policymaker in Washington, you realize, hey, I want this on my desk. But again, for someone like Jim, what you can sense from it, you try to be as objective and independent as possible. You have a long-term view, and then as soon as the data comes out or a policy move comes out, and it either strengthens a trend, then you go with it, or if it causes you to change your mind, and you should do that as well. But we'll have Jim back on again when it makes sense from a Fed perspective. And it certainly seems like that's going to happen again, in 26. If Rich has a number for us, that is.
Yeah, I'm ready. I mean, there's a bunch of cuts being priced in for next year. I think that what you're seeing is maybe 2 more cuts basically priced in, with the sort of terminal, which means sort of the rate at which the curve sort of flattens out at about 3 and let's say 3 and so between 3 and 3 and a quarter. So yeah, so 2 more cuts basically priced in for next year.
Okay, well, we'll have to keep an eye on that. But Keith, there was also some interesting news. We were sharing an article in our group chat there that we kind of wanted to flag to the audience, to our listeners, as something that we're paying attention to, that we think is really important. We called out, a lot of things over the years, obviously, QE being the most recent one. But the other one was the document that came from the White House, and it was effectively like a 30-page document outlining sort of the U.S.'s national security strategy. And so effectively, in summary, it outlines an America First framework focused on restoring U.S. sovereignty, rebuilding domestic strength, and sharply narrowing foreign policy priorities. It effectively went on to argue that past decades of globalization, mass migration, military overextension, and over-reliance on international institutions has weakened America. And then the new strategy moving forward will focus on reindustrialization, energy dominance, strong borders, and maintaining overwhelming military and technological superiority, while demanding far greater burden sharing from allies, especially, Keith, in NATO and the Indo-Pacific. So I thought that was like pretty interesting. It actually goes on to really kind of lament against Europe. It urges Europe to regain cultural and strategic confidence, and shifts the Middle East crisis from crisis management to partnership. Anyways, it's a really, really good document. Not whether you agree with it or disagree with it. I think it's just incredibly important that they've effectively outlined in a 30-page memo exactly how they want to move this country.
Yeah, I think you used a different word than lament. I think you mentioned there towards Europe. Yeah, so to give you an idea how big this is, I'm in a couple chat rooms that does not include, the Loonie Hour guys.
How dare you?
I know. I'm sorry, Rich. But it is. There are a lot of European-based traders in there, and some Americans as well. And when this came out, like within an hour of this thing coming out, these guys are all over it. And the EU especially is in shock over this. And so the reason we're sharing this with everyone here in our audience is not because, hey, this is something that came out, is interesting, and it'll be forgotten about next month. This is a policy change, or a sort of a strengthened policy change. And it is by the deep state, by the way. It doesn't matter if it's the Republicans controlling the White House or the Democrats. This is what the U.S. is doing. And they're moving increasingly away from the old world, which we talked about a few minutes ago with Jim. They are less interested in NATO at this point. And it's really shaking the foundation of what kept the West together after World War II. And some people think, well, no, NATO has this, it has the article, this, and that. It doesn't matter. The Americans have shifted dramatically on what they want to do. And they're realizing now that they rely on a lot of other countries and economies and markets to make their country and an economy function well. And they are clearly changing, even though we had the NVIDIA comment that came out this week, the Americans are changing the focus towards China dramatically. And everyone's following the Venezuela story, of course, but these little things are happening. And it is, I'm not trying to make it sound that it's not traumatic. It is very traumatic. It's going to have a big change in how the world moves going forward. But like, give an example. The Department of Defense is now called the Department of War. And people say, well, that's just a name change. It doesn't mean anything. It means a lot of stuff. The Americans are restructuring their entire military to be ready to protect it no matter what comes next. And they are shifting it more towards the east, of course. But they also created, it's this arm of that, or department, it's called the Office of Strategic Capital. So I encourage everyone to read a bit more into that. I mentioned that name, I think, last week. But this is a newly created group within the Department of War. And they've been allocated a couple $100 billion, and they're going to focus specifically on rare earths, critical minerals, and what they call covered technology. So like AI, semiconductor and chips and stuff like that. The Americans are going all in to try to strengthen their domestic economy again. And, they're basically telling the Europeans, you're on your own. If you guys want to continue to go down the Ukraine-Russia path or avenue, go for it. We may not be there to support you. And again, this should attract it should capture everyone's attention. And I think, as well, if anyone is interested, there's actually funds being created to capture this. We have access to it. but you need it's a $5 million ticket USD to get into it. So, but if anyone in the audience, they have an interest in hearing a bit more about this stuff, just reach out to me. But again, this is a significant change in how the Americans are moving themselves. And we'll have a lot more information on this as we continue into next year.
The only thing I wanted to just quickly add, Keith, which is I think your point about it being a structural and long-term sort of borderline apolitical change in the way the US deals with its adversaries, is that Canada, whether you like it or not, is part of that. Because we share a 3,000 mile, I prefer kilometer, 4,000 kilometer border with the US that's unguarded. And I think that this explains a lot of the pivot towards Canada's spending on defense, which was a massive chunk of the big, beautiful budget deficit, and the industrial policy around mining for rare earths and the oil pipeline and the infrastructure stuff around all of that. And I think despite the rhetoric from Ottawa about how Canada is shifting away from the US, I think the proof, frankly, is in the pudding. And the focus on the budget deficit with respect to mining and defense. I think that's the interesting bit.
Yeah, this is incredibly positive for Canada, but Canada just has to say, okay, we recognize who our friend is going to be, and we know we go in that direction. But again, like the Americans, they came up with a peace plan, for Ukraine, Russia, and the EU completely rejected it. Almost every single point that the Americans came up with. And again, it doesn't matter whether you agree or disagree with any of this stuff. That's irrelevant. Kind of like Jim was teaching us with markets, you have to look at which way it's going. But the EU are digging their heels in. And the Americans are saying, okay, you guys can go the direction if you want. We're going in this direction. So I hope Ottawa is listening, because this is a big horse you want to attach yourself onto. If that's the right analogy, Rich, maybe?
Let's say toboggan.
You ride the horse? No, I don't know. Something like that. But anyway, we'll have a lot more of this as we go forward. But again, it's one thing, to sort of have, rare earths would do well, everything. But when, this enormous government arm is pouring billions of dollars into it, not just to make money on it, but to protect their domestic economy and national state, it's a big deal. It's a big deal.
Well, that's a good place to wrap it up. As we get closer to the holidays, we will continue. The Loonie Hour has, with 218 episodes, never missed one. So we will continue to put out some episodes over the holidays, working on a couple guests, additional guests to come on the show. There'll always be something to talk about. So, I mean, those, we've introduced a couple key themes this week, Keith. And I think that it's lots to pay attention to as we head into 2026. But as always, guys, we hope you found this valuable. We hope that you share this episode with at least one friend or family member. Hopefully it's a discussion at the dinner table over the holidays that, we can continue to build the Loonie Hour community through that mechanism. And as always, we'll see you next week.